ETFs, mutual funds, equity indexes, what do they really mean and how do they impact your investments? If you've ever been confused by these terms, you're not alone. Today, we're breaking it all down so you can invest smarter and with confidence.
Gary, moving to the fifth thing, we're talking again, investor education and knowledge. Today, we're talking ETFs, mutual funds, as well as equity indexes. So, Gary, I'm going to break those up. We're going to start with mutual funds. And Gary, I want to know, tell us more about mutual funds. What are they? Why should you care about them as an investor?
All right, Rob. So let's start with mutual funds. A mutual fund is simply a vehicle that pools investors' money, and then the fund managers will invest that money according to something called a prospectus. The prospectus is the legal document that explains to people we are going to invest in certain things. So some mutual funds will invest in stocks, others in bonds, others in domestic companies, others in foreign companies. Some will invest in large cap or small cap stocks, or sometimes there are specific industries. So you might have like a technology mutual fund, which will invest in companies like we were talking about earlier, like NVIDIA or Google or Microsoft. You might have a mutual fund that invests in energy or energy production, really any kind of industry or different way of breaking things up. But what you're doing is you're investing with a company, and then the fund manager will invest that money for you within the bounds of what's described in the prospectus.
Gary, mutual funds charge a management fee. Just curious, like how can an investor know, or where should they even look in terms of this management fee? And then how are they being managed too? Actively, passively? How much work's actually being done in these funds?
It depends. So in general, so first of all, the management fee has to be disclosed. You can find that in the prospectus. You can find it on the company website. Like if you look up the particular fund, you go to their website, it will tell you how much they charge. This is information that's disclosed very clearly. And, when you're looking at investing, the company will send you the prospectus. Now, someone might say, hey, listen, I don't want to read 100 pages of legalese. That's fine. You don't have to. I understand why somebody, if you're looking at 10 mutual funds, you might not want to read 1,000 pages written by attorneys. I get that. What you can do in that situation is just read the description of the fund, the kinds of things they're going to invest in. And then if you take a look, the fee structure there will be prominently disclosed. It's not the kind of thing that they can hide. In the past, almost all mutual funds were actively managed. And what that means is that there is a fund manager who exercises discretion. There are more mutual funds now that are passively managed, which means they're designed to track a certain index or a certain sector index. And their goal is just to maintain certain weightings and try to make sure they match market pricing.
Gary, moving to ETFs, want to talk about those. Gary, tell us more. What are ETFs, and then how you approach investing in ETFs?
So ETF stands for Exchange Traded Fund. And basically, we can make this one really simple. Take everything that we just said about mutual funds. So, a mutual fund, you're simply investing in a pooled vehicle where a fund manager will invest that money for you according to what they tell you they're going to do in a particular sector or in stocks or in bonds, domestic, foreign, market cap, right? So ETFs are basically the same thing. The only difference is instead of calling the fund company and, sending them a check or wiring money in or, dealing with them directly, you can buy these funds like they're individual stocks on an exchange. So with a lot of them, you can go into your brokerage account and just put in the ticker of that fund, and you can buy it and sell it at any point throughout the trading day. They often have lower fees and, increased liquidity. So for some people, that'll be a good thing. For others, if you overtrade, it's probably a bad thing. But what it does is it takes everything that people like about mutual funds and makes it easier to buy and sell them and easier to track them instead of having a bunch of individual investments where you get separate statements every quarter. You just see everything in your brokerage account. It just makes things a little more flexible and easier for people.
Yeah, I think that's the big thing there. More flexible investing option. Gary, final piece, this week's 5 things. Tell us about equity indexes. What are they? Everything we might need to know about that to wrap up the show.
All right, let's give examples of what those are. An equity index, the big 3, and there are a bunch of them, but the big ones that people tend to track are the Dow Jones Industrial Average, the S&P 500, and the Nasdaq 100. And what these are benchmarks that track the performance of groups of companies. And there are all kinds of like issues with the way they do these things, Rob. So one of the reasons why the Dow Jones Industrial Average isn't particularly useful is for whatever ridiculous reason, mostly history and lack of computers a couple hundred years ago when the index was established, is it is price weighted. And so what that means is that a stock with a high price has a greater weighting in the index than a stock with a low price. But the stock with a low price might have a much larger market cap. Now, if you look at the S&P 500 or the Nasdaq, those indexes are market cap weighted, and that's a much more sensible way to do things, except we've got a situation right now where, the top 7 companies are something, like a third of the index, or maybe a little less than that right now, given today's, tech blow up. But the point of all this is that equity indexes can be an interesting way to track market performance. They're benchmarks. There's something to look at to get a sense of what the market in general is doing. I would just point out that whatever methodology people are using is always questionable. These are just sort of benchmarks, something you can keep an eye on, but it's not necessarily, actual investment performance. Now, the one thing people can do is these equity indexes are not investment products. However, there are passively managed ETFs. We were just talking about exchange traded funds that are designed to track the performance of those indexes. So, you can't go to Standard & Poor's and say, I want to buy the S&P 500 index, but there are ETFs that will come very close to matching the performance of that. Same thing with the Nasdaq. And so you basically feel like for the Nasdaq, it's QQQ. For the S&P 500, they're called spiders. That ticker is SPY. Dow Jones, they're called diamonds. But basically, you can buy investment products that will track the indexes if that's something you'd like to do.
Great stuff, Gary. Thanks for breaking all of that down for us between ETFs, mutual funds, and equity indexes. That concludes this week's version of the 5 things. Thanks so much for everyone that watched and tuned in. Again, be sure to subscribe to our YouTube channel. Give us a like, comment, good, bad, indifferent. Let us know. We'd love to hear from you. You can also head to our website and use the Ask Gary feature. Any question that you might have, that'll go directly to Gary, and you may even see your question end up on the show. Thanks so much for joining us. Again, be sure to head to deepknowledgeinvesting.com, sign up for that free subscription,